This is our Forex blog for March 3rd, 2014. And if this is the first time you've seen this blog, we create some of the most cutting-edge indicators and tools for Forex traders. And our software also works for stocks and futures as well, and pretty much any market that eSignal supports. Basically, one of the easiest ways of trading is using our currency indexes. These are synthetic charts that we create ourselves that you can't get elsewhere. And they're very similar to the Dow Jones, S&P 500, NASDAQ, Russell, in that they show what each individual currency is doing. And basically, in a nutshell, you want to buy the strong currencies versus the weak, and you want to sell the weak currencies versus the strong. And by seeing each currency as a chart, you can actually see when it's making higher highs, when it's forming a double bottom, when it's finding support at a major support area like the point of control the previous day. This is the price most actively traded during the previous day. Here in the pound, you can see this is the price most traded during the previous week. You couldn't get above it. It's extremely likely to go down. And so same thing here with the euro. It went underneath it, came back up by a little bit above it, a little bit lower the second time, broke back down and trended down. Meanwhile, the dollar was strong. So basically, weak euro, strong dollar, you're looking to sell it. And if this is too complicated for you, you can just simply take our Forex signals. Now, I'm still working on the ones that show up on Sunday. Sunday's a tough night, usually because there's gaps and there's some weird trading results. But, you know, we had a loss here, pretty much a small loss, small win, and then, starting today, I'll probably 4 pip loss, 10 pip win, 5 pip loss, 20, 25 pip win, 20 pip win, 30 or 40 pip win, 10, 15 pip win. And if you take these signals in the direction that it's pretty clear with the currency index as it's going, once the dollar was underneath its hourly moving average, yesterday's most actively traded price, or I should say previous trading day, Friday, once it's above there, especially after 7 o'clock, and the euro's trending down, you're looking for sells. So you might not have traded the euro dollar at all, but after 7, you're definitely looking for some sells. So, these last few trades, small loss, big win, huge win, win. Pretty much all wins except one. And you can see also the pound's trend is down. So you bring up a pound dollar and you focus on sells, especially after 7. All right, so here's 7. Win. You'd be short here at 27. You got stopped out here at 31. You lost 4 measly pips. You lost a little bit here. You won, lost, and had a huge win on that last one. Short here at 30. You're out here at 67. So you made 67 pips on one trade. And really, that's the key to trading. Most professional traders make the majority of their profits off of less than 10% of their trades when those they get those home run trades. The rest of the time, they're trying to break even. If you have a 15 pip win here and a 4 pip loss here, you're up 11 pips. You're in here at 31. You get stopped out at 28, right? That's only a 3 pip loss. You're still up on those 3 trades, even though you've lost 2 out of 3. And then here, you're short here at 31. You're out at 21, so you made 10 pips. So even this 10 pip win here got rid of this loss and this loss. And so basically you have this win and this win plus a little bit more. You have maybe a pip profit on this one here. It flips and goes short. And unfortunately, sometimes when we identify the trend being short and it's extremely weak, sometimes it doesn't go down right away. But look at this. 1, 2, 3 losses in a row and then a major huge win. And that's really the key to trading. But it's also the main reason why so many traders lose money. They get into a trade, they lose. They get into it again, they lose. They probably don't even take this one. And if they, well, thank God I didn't take it. And then guess what? The double top pattern up here, it gives them all their losses back on those 2 or 3 trades, plus some. Now, you can also draw fibs, trend lines, and obviously, here's the high, here's the low. You probably wouldn't have taken this trade. You might have taken this one. You certainly would have taken that one. There's no doubt in my mind I would have taken that one. But you can see it did go a little bit your way. 24 went down to 19. If you're watching that real time, that's a trade that really should fall off a cliff. And the fact that it doesn't, maybe you get out of this trade with only 3 or 4 pip loss. and then you make 60 pips on this. And again, you also have the fib targets up here, down here, that will tell you where most of the time it's going to reverse. Probably 60 to 70% of the time, the 1.382 stops it. 80% of the time, the 1.618, and virtually 90+% of the time, this one does. So you can actually get out of this trade right here at 54 versus 64 and make another 10 pips. This extra profit by just simply learning, how Fibonacci profit targets work and so forth, you can do much better. Also note on the bottom we have Fibonacci time extensions, and I'm just starting to put this into our patterns. But a lot of times the weakest currencies, when they start falling, there's no pullbacks. And so this is very likely when the market's really weak to go lower, but you can see it's before the fib target, or the first fib time extension. This is a 38% retracement right here. So you can technically, by using the fib time targets, avoid 2 of these trades. You'd only have 1 loss and 1 just absolute huge home run. So the more you know, the more you're going to make. A lot of people that I talk to really just want to take the signals. They have no interest in learning. They have no interest in doing the hard work it takes or spending the months and months, if not years, to learn everything. Most new traders, there's at least 100 things they don't know. And, that's one of the reasons why I just stopped doing the classes and went back to trading full time. Our tools evolved over the last 9 years to be so good that I thought, I'm just losing a fortune teaching class to people that really, many of them didn't want to even learn. So I created the signals. I'm auto trading these myself. There's a huge incentive for me to get these to be super accurate, because I don't want to wake up losing even $500, let alone 5 or 10 or 20,000 when I'm sleeping. And every week or two, I'm going to release a new version of the software that has the signals updated. And we're not releasing the auto trading for many reasons. One, most people don't have enough capital to trade with the brokers that we hook the execution software to. We're not going to obviously use a retail platform like MetaTrader. We use a professional platform, which requires big capital. And secondly, I don't want people using my hard-working signals to trade other people's money and get a commission, when it's not even their trading concept. So someday we might offer auto trading or managed accounts, probably managed accounts where we get 20 to 30% of the profits. If there's no profits, we get nothing, zero, which is the way it should be. If I don't make money for our clients, then we don't deserve a penny. And when we do, we deserve a good cut of it, because we did all the hard work. And, I've personally lost, I've made more than I've lost. But if you count all my losing trades over the last almost 14 years, I probably had $5 million worth of losing trades. So, that is why our tools work, because I have learned as much as anyone else out there what doesn't work, and our tools do not take those type of trades. We trade with a statistical trend, and we buy and sell the strongest currencies versus each other. Let me just give one more example of this. You can see the Australian trending up. Now keep in mind the daily, weekly, monthly trends down. And so you don't know that these trends are going to continue up like this. But you have the Australian going up. We saw the pounds going down, the euros going down. And so you can sell the euro Australian and the pound Australian, and you're going to make money in this. It's that simple. Notice, that this had a downwards bias, and, it's trending down. You get short. You had an opportunity for a small profit. You make money here. You make money here. There's a nice little rectangle pattern right here. You get short, and of course you want to draw your fibs on there to know, like I said, where the 80% likely profit is. And you can see it went right to the 2.0, but it did bounce off, installed at the first one, stalled the second one, and bounced off the third. And then here's the pound Australian. Again, like I said, just focus on trading these weak ones. You have a small risk. Your profit in this case is 2 times bigger than the risk. You get a pullback, you get short, here's your stop. Guess what? This one came down, came back up. Anytime you get a down, up, down pattern, if it doesn't break this low, you want to get the hell out of it, or at least move your stop to above the swing. So you lost a tiny, tiny amount here. When these trades don't work, whoops, that's not what I meant to do. When these trades don't work, you lose a tiny amount. And your wins tend to be bigger. So you go short again here, and even if you get out right here, guess what? That's your risk, that's your reward. It's a bigger reward than risk. And here's another rectangle pattern. You go short with your stop above here. Here's your original risk. Pulls down, comes back up. You move your stop down to here, and it goes down again. And guess what? You drew your fibs on there. Off of this, your fib targets are down here. Once the bet, it bounces off the 1.618, like I said before. Oops. So here's the first, here's the low, and guess where it bounces off of? Finds support at the 1.618, which really a very high percentage of the time it does. It rarely goes to the 2.0 level. The 1.618 is a great place to exit all of your trades. If you want to get out of half your trade here, and if it bounces up, let the trailing stop get the other half, and then if it goes down here, you get out of the second half. Your average price is right in the middle. You're out at 86.61. You're short this at 24. So you made over 60 pips while risking less than 10. That's a huge win versus a small amount of risk, and that's the only key to trading, whether you use our methods or anyone else's. Trading's not hard. You just have to be willing, just like baseball players are, to, the best ones hit 300. They get hits 30% of the time. They fail 70% of the time. Now with our methods, that's not going to happen that many days, but it will happen occasionally. You got to, like you saw in that one trade, 3 losing trades in a row, 7 pip loss, 8 pip loss, 7 pip loss, and then guess what? 60 pip win. So you're up 30 plus pips, even though you only won 1 out of 4 times. And the more you know, the better you're going to trade. I didn't even get into support resistance and support resistance clusters, putting your fibs on there and looking for other support resistance like daily highs and lows of the previous day, weekly highs and lows, monthly highs and lows, daily, weekly, monthly pivot levels, value areas, previous week's high and low. Let me just briefly show you. Very few software products have this value area. This shows you where most people have positions during the previous day. And look where the market bounces off of. Value area high for the previous day, value area high the previous week, value area low for the previous week, and happens to be the previous day's value. This is where most people have positions during the previous day, previous week. Just look at it bouncing off these things. Boom, 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 boom. And this is just one, or actually daily and weekly. This is just 2 of many different areas. We also have intraday value areas, which tick by tick we show you where most traders have positions throughout the day. If you want to use 4 hours or hourly, doesn't matter. This will put little lines on the chart that show you where most traders have positions. During the previous 4-hour period, it's up here. When it's underneath it, you want to short. Right here, during the previous 4 hours, most trades are right here. When it's above that, it's more likely to go up. Right here, all right, new 4-hour period starts. Underneath that, it's more likely to go down. Underneath here, more likely to go down. Right here, more likely to go down. And it acts as resistance. Once it busts above there, it's likely to go up, which it is slightly. So these are all, there's a lot of things you can learn to improve your odds over our signals.